Well, greetings and welcome to the October 2025 Investment Strategy Brief. In this episode, I want to talk a little bit about the fact that we've been through a period of really robust growth in the first half of this year, but we're kind of expecting a little bit of a slowdown, maybe in the fourth quarter, only to see growth reaccelerate in 2026. So we sort of entitled this session, Slowdown Ahead, but let's jump into it. As we know, we've been dealing with a lot of different geopolitical situations and risks that we're mindful of, when it comes to things like China competition, U.S.-China competition. We know that's in focus. We think about things like the fiscal trajectory and where we're headed in that regard, as well as things like the potential for a cyber attack. So just watching as things are unfolding, keeping an eye on things. We'll get into some of those details in a moment. But of course, in the current environment, it's as much about the military hotspots. So we have Russia, Ukraine, we have the Israel-Hamas situation. And from almost like a global economic perspective, we have to keep an eye on all those hotspots around the world for sure. Now, this is against the backdrop, of course, of big changes in D.C. this year with the second Trump administration. We know about big changes in tax policy. We know about the tariffs and trade policy and how that's all affecting things. But as we've discussed, even though we're in the midst of a shutdown, the spending bill was passed, and as we look into 2026, one of the sort of the catalysts for a potential of continued growth is really a little bit of extra money in folks' pockets when it comes to tax savings and how that will be stimulative for the economy next year. Now, turning to the economy, we know that we've been back to a trend growth line of about 2.1%. We're reminded by this blue box in this chart on the right that consumption is over 2/3 of the economy. So how the consumer is doing is super important. And ultimately, then when we look at the consumer, this is one of the areas where we're seeing potential cracks. So retail sales have held up pretty well. But what we've seen is interest on debt go up, of course, with higher interest rates, and that's put some pressure on the consumer. We've seen consumer confidence and sentiment fade just a little bit. And digging in a little bit more, we've seen the labor market, while it's generally been pretty robust, we're seeing signs of cracks, right? So non-farm payrolls, which is a little bit out of date with the government shutdown, so showed us some weakness against a backdrop where things like the unemployment rate have held up. So again, we'll wait and see how the data unfolds, but there's just this general sense that there's a softening in the labor market. And so again, this could be an indication that the consumer is stepping back a little bit. This chart, for example, shows that when we look to the 10 years prior to the pandemic and then in the recovery, 2023, 2024, those 2 years, basically consumption, it's the green bar in this case, green part of these bars, represents somewhere between 1.5% and 2% annualized growth. When we look at the first half of 2025, that's reduced to, in very round numbers, about 1%. So we've seen this modest slowdown in the consumer, and people are expecting that to continue in the second half. I mentioned the idea of sort of stresses on credit, so if we see just a little bit of a move in delinquency rates on credit cards. We talked about the labor market cooling, so people maybe don't feel quite as confident in their job. The Fed has been analyzing data. They've commented on a slower consumer, especially in the lower middle income range. And then we've seen savings remain at historically low levels, savings rates. And so basically, there's just a little bit of less firepower, if you will, in terms of the consumer. Ultimately, all that coupled with the potential for sort of a softening sentiment, as we've seen, basically we can anticipate the possibility of the consumer slowing down. All that rolls up to this idea that we are expecting, based on the consensus views, for the economy to grow at just under 2% in 2025, and then reaccelerate a little bit into next year, 2026. And so what people are watching for is just maybe a little bit of a slowdown in the fourth quarter. Now, this is against a backdrop where inflation isn't fully tamed by the Fed standards. Remember, this chart shows us 3-month rolling averages, the blue bars being consumer price index, the gray bars being producer price index, and then the green line representing the monthly equivalent of the Fed's 2% target. So we've seen inflation cool down to around the Fed's 2% target, but not consistently below that. And so that's the kind of thing we're watching for. But that's against the backdrop where the Fed is focused instead of just on inflation to sort of broadening it out in their dual mandate to the labor market. So the fact that they see the potential for this softening in the labor market caused them to cut at their last meeting, and the market's anticipating more both through the balance of this year and into next year. So in some ways, one of the things that could spook the market is if the Fed doesn't act quite as much. We've talked about that before, but right now the market's pricing in a number of additional Fed rate cuts looking forward. Now, this is against a backdrop, as we've discussed before, of a fiscal transition that's occurred in a fiscal trajectory, really, that's occurred in the U.S., where we've built up our debt, especially when it comes to the federal government. And so we've increased our debt since the financial crisis to the tune of the equivalent of 66% of GDP. That's incremental growth in the debt. And with interest rates higher, that means the cost of our debt is crowding out other elements of our annual budget as an entity, as a government, right? And so that's something that's in focus. We're talking about it a lot. We're seeing various corporate leaders and government leaders talk about it. And it's something that needs to come into focus. And in fact, one of the things we've been sort of taking a stab at, and it really based on research and what a lot of other folks are doing, is sort of framing out sort of where we are when it comes to the deficit and the debt as a percent of GDP and where we want to get to be a little bit more stable. So right now the deficit sits above 6% of GDP. The debt at around numbers 120%-ish of GDP. And healthy numbers by a number of folks who sort of talk about this kind of thing, we would have a deficit at or below 3% of GDP, and then it's more than half as big as it is now, and an overall debt level in the range of 60 to 80%. And so these are sort of almost like stakes in the ground. Can we get to those levels to kind of get ourselves back on a better track? And so this is going to require less spending. It's basically a deficit reduction that would have to amount to somewhere between $7.5 and $9 trillion over the next decade to kind of move in this direction. And the word that sort of jumps out with all this is the idea of austerity. So on one hand, we're going to have to cut spending. And honestly, I think there will be a point where the entitlement programs will come into focus for potential reform. And there will be other ways that the government will be looking for gains in efficiency, all while we need higher revenue. Now, on one hand, we can increase tax rates, but that is sort of the opposite of stimulative. And we can also think, though, about ways to sort of creatively grow and help inject growth into the economy. And if the economy is growing and revenues are going up and earnings are going up, that means taxes are going up, and that's a good thing. So again, it's going to be a lot of work and a lot of focus. It's going to require a little bit more political resolve than we've seen from our elected leaders. But at least we're starting to hear about, and in some ways talk about, a framework sort of directionally where we want to head for things to get better on this front. Now, turning to the markets, basically we've talked about interest rates being higher, so they remain pretty elevated compared to certainly where they were, for example, during the pandemic. But I think that's the new normal, right? Interest rates are higher. They're going to be here. As an investor, I can put money to work in various categories of fixed income, and that is very appealing on a forward-looking basis with these higher yields. So that's a good thing. But, when we turn to the equity market, we're going to get into the fact that the market has been super resilient. And some of the reasons perhaps for that. But then, this tells us that, markets can be a little bit more sensitive to disappointments or worries, and the potential for a pullback is real. So as it relates to some of those foundational sort of tailwinds to the equity market, one of those really in some ways is anchored in our long-term themes. So we have things like productive competition. That means, for example, that if we're competing with China in the area of AI or other ways, that means they're fighting hard, we're fighting hard, and we're both getting better. And that's actually in an interesting way, sort of a positive. We know that there's different changes in patterns on how consumption's getting done and businesses are being formed when it comes to innovation to serve consumers in a better way. We're seeing shifting demographics this is, among other things, about longevity and people wanting to live longer. And what are the innovations we're seeing in healthcare to help with that? We know that strategic resources like energy, water, food, these are all important. And innovation to make energy, food, and water more readily available and protected is in keen focus. And then across all those themes, there's artificial intelligence kind of helping, and our AI is in a way a part of the fourth industrial revolution, or the idea that technology innovation is really blurring the lines between the physical, digital, and biological worlds. And so all of that translates to a lot of investment opportunity. And one in particular, of course, is artificial intelligence. We've talked a lot about it. We've written a lot about it. We got into the idea that the view is that AI will be additive to the workforce, but it will require some retraining, some reallocation of labor. We have focused on the idea that AI is ultimately about being more efficient, being more productive, and ultimately more profitable as a result. We've dived into a few different areas like healthcare, cybersecurity, and financial services, for example, and where we're seeing kind of real tangible impacts of AI already. And so that's a backdrop in a way of sort of optimism, given how quickly and substantively our world is being changed by artificial intelligence. Now, this is all feeding into the idea that profit margins have remained strong and are expected to grow higher, and that earnings are growing at a above long-term trend rate. And all of that is sort of, again, a tailwind for the equity market. And so this chart is interesting because we started the year and we put that gold line up there. That was our year-end target for 2025. We moved through that at the middle of the year. Then we revised our target a little higher, and we moved through that a number of weeks ago now. And so the market really has performed quite well, despite the decline we saw in April around tariff and trade fears. All to say that especially since those declines in April, the market's recovered quite handsomely. And we're sitting here year to date with the S&P 500, for example, up around 15%. But most segments of the market having fully recovered, those check marks you see on this chart, means that index fully recovered from those lows or the highs before those lows back in April. And so, again, some very positive sort of results in the equity market. And what does this mean in terms of valuation? But that means, as we've seen before, that markets are very richly valued, especially when we do it on a cap-weighted basis, which is sort of a normal way to do it, that those big tech-oriented companies that have done so well are sort of driving valuations higher. And the PE ratio, in this case of the S&P 500, sits at almost 26% a premium to the longer term, meaning 10-year average of PE. So that tells us that markets are very richly valued. Now it's been supported by these higher levels of growth and the optimism that I mentioned. When we look at an equal weighted basis, there is still a little bit of a premium, but it's only about 3.5%. And so when we look more broadly at the market, the valuation isn't quite as rich. But just again, the takeaway from this is just to recognize that while things have held up and gone higher, this is certainly an environment where we should expect at least a little bit of a short-term pullback. It could be any kind of negative news. There's, earnings that are happening right now for third quarter. Maybe there's a disappointment. We've certainly seen a few cracks in the credit markets. If those look more serious, that could be a disappointment. We could see further flare up in the military hotspots. That could be a problem. Anything could kind of just trigger the market to be a little bit almost like emotional and trade lower. But, as long-term investors, in some ways you want to be ready for that. Be ready to sort of stay invested through that. But it does beg the question, when we're looking at things, are there things that we can focus on to kind of be ready for it? And so just to highlight a couple more pieces that we made available, we have an article recently on the third quarter earnings, and where we're seeing, generally speaking, data hold up pretty well, but where we're going to continue to watch that. But then some work that we've produced that really talk about, in a way, not waiting for the pullback. And what do we mean by that? Well, there's a variety of scenarios we could talk about. For example, let's say somebody's sitting here today and they have money that they intend to invest in the equity market, but markets are richly valued, so it feels a little uncomfortable to get money to work. This would be a great time to consider that traditional dollar cost averaging, a little bit at a time, let's say month after month, quarter after quarter. And then if the market pulls back, that just creates a little bit more of a buying opportunity as you do that. Another one would be given the excess returns of stocks versus bonds. Sometimes that stock bond mix is a little out of sync with what might be your desired long-term mix. So rebalancing and selling some of those stocks and reinvesting in bonds, this is a good time to do it. We've seen a number of cases where clients are wanting to de-risk their strategy. Maybe they're entering retirement or getting closer to a time when they want to draw on their portfolio. A lot of times people don't think about this when the markets are up. They're just sort of celebrating it and feeling optimistic. But actually, when the markets are up, this is especially a good time to think about if you're planning to de-risk for one reason or another, meaning lower your equity exposure, this is a good time to do it. Now, another thing to consider, and this really relates to sort of the potential for a pullback, if people are really worried about a more meaningful decline, and we have a number of clients that have talked to us about this, this is a time to think about, sort of almost think of it as diversifying ideas, that, and sometimes the term that's used is black swan. It's sort of like a portfolio for troubled times. So this could be comprised of things like precious metals or hard assets or other commodities. But the idea is to kind of look at asset categories and products that are less correlated with stocks and bonds as at least a mechanism for diversification. But often when things turn south, these are the kinds of investments that could hold up pretty well. And so we've got a number of clients asking about that, and it's certainly a good time if you're open to that idea and interested in understanding it. It's a good time to talk to your financial advisor at Stifel about those ideas. In any event, what's interesting about a potential pullback is I mentioned all these areas of the market, the big tech-oriented companies, for example, being very richly valued. If we see a turn, it's not uncommon for those sort of big recent successes to kind of lead the market down. And so another thing we've mentioned to people is if you felt like, hey, either I don't have as much exposure to that kind of part of the market that I'd like, or I haven't established a position yet, when you see the pullback, that's actually a good time to establish or add to a position. So anyway, those are some of the things we wanted to get into. The idea that, hey, we're going to potentially see a little bit of a slowdown. The markets have held up and have been resilient. We're in a period where, therefore, the markets can almost act a little bit more emotional to bad news, and we could see a pullback. And so you want to be thinking about that. Number one, to be ready to handle the volatility. But number two, if you're thinking about some changes, this is a good time to reflect on those as you look forward. So listen, thank you so much for checking out this episode, and we'll see you in November. Thank you.